Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nick Shermans and Aaron Varghese work for Pure Portfolios. Any opinions expressed by Nick and Aaron or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everyone, and welcome back to another episode of Blind Spot. In a recent podcast episode titled, Are You Ready for a Recession?, we talked all about how history doesn't repeat, but it often rhymes. And we don't really learn from the past because we always think that this new time, this new event is different. So today we are diving into the behavioral side of investing and the mistakes that investors often make during a bear market. So we hope by the end of this episode, you know what things to avoid during difficult market times.
I just ate a burrito from Chipotle and it's 98 degrees. So pardon me if I'm a little slow.
I'm feeling that today as well. I've got my second cup of coffee.
Yes.
But it's good. I'm excited for this episode.
Yeah, I think a lot of this is, this is part of our first point, but a lot of these lessons, if you will, are not earth-shattering. People have heard most of this before. We're going to put a little spin on it, but people don't listen to anything when the market is going up, right? It's easy to be an investor. And then when the market goes down, a lot of these time-tested mental shortcuts and strategies for keeping it on the rails are all of a sudden enlightening. Because people are paying attention, like they're scrambling because, they were leaking oil when the market was going up. And what a bear market does is it exposes gaps. It exposes your blind spots. So hopefully you all get something out of this and can become more centered and rational investors.
What's your Buffett quote about swimming?
It's something to the effect of, you can only see who's swimming naked when the tide goes out.
Love it. Okay, so you talked about how boring advice becomes enlightening during hard times. How have you seen that over time come out?
Well, first off, a caveat. So a lot of these lessons, there's several ways each of them are manifested in real life. So we'll try to weave in some examples, but probably the most obvious one is, and I see this in some young people, and it's really disturbing, is when, markets are going up, they're happy to dollar cost average, to save money and invest it each month. They feel really good about their financial futures. And then when the cycle turns, they might want to sell, they might want to stop saving because it could get worse. And it's like, that's a fundamental misunderstanding of investing, what's supposed to happen, and just the natural ebb and flow of financial markets.
Something that comes to mind is that every dollar is either spent on today or invested for your future. And I think it's really hard to see far into the future when you're decades away from that retirement date. You're contributing to your 401k and you're saving and you're investing for all these different things that you want to do and achieve in your life. But when you see your 401k account slowly start to slide down, it's really difficult to think, okay, I'm going to continue investing for retirement, or I could have that cash in hand now and use it for something else. So I think that's where that kind of comes into play for the younger person.
Well, and it's not just younger people. People in general want to consume today.
Yeah.
Like, it's really hard to go not buy a BMW, or, when you see your friend buy a brand new house, not to go want to buy a house. So humans in general are prone to spend money. There's billion-dollar complexes in this country, advertisers, marketers that are trying to separate you from your money. And so it's a constant fight. And what people need to be better at is just delaying instant gratification, the need for instant gratification, and delaying consumption for tomorrow. And I always say this about young people. Like I'm 40, I don't consider myself young anymore, but they should be rooting for the market to go down, right?
Yeah.
They should be rooting they should be rooting against most major asset classes because they can save more today and eventually those asset classes, historically have bounced back. That would be a good entry point for them. But a lot of humans do the opposite of what they should do. And I don't want to steal all of our thunder, but for a retiree, it might be, when times are good, I don't want to own these bonds, right? Bonds have a capped upside, yields are low, it doesn't make sense to own them. Let's put 100% of my balanced portfolio in stocks. Like that's a common conversation that we have with people. And they're completely forgetting how they feel about risk. They're completely forgetting the other side of the cycle. They're completely forgetting the historical relationship between bonds and stocks. Bonds tend to mitigate risk during difficult market environments. And then once the cycle turns and stocks are down by 30%, well, why don't we own more bonds? And it's like, this is not how investing works. And all these things we did in the context of an up market made complete sense. But people, again, they overweight what's happening now, which tends to be a pretty bad market environment. So hence the why don't I own more bonds? During good times, it's why don't I load up on stocks? Seldom are things black and white. That's why we always stress building a portfolio that reflects the way that you feel about risk rather than reacting to every ebb and flow in the market.
So on that note, I think we should jump to kind of seeking risk when things are good and shunning when things are bad, because that mindset plays directly into this.
Yeah, and I can't tell you the amount of times I've heard this, and this is a joke. So when you meet a new prospective client, we're trying to get information out of them to, one, build them the correct portfolio. We want to build a financial plan, but we're also trying to understand their blind spots, what personal experiences that they have that shape the way they view money. And after asking questions and trying to uncover this, many people tongue in cheek say, well, I'd like to make money, but I don't want to lose money. And they say it as a joke, but they're actually serious. And that's how they think. There's so many people that think that way. And that's not how financial markets work. Every 4 or 5 years, going back 100 and some odd years, markets get difficult. Things get weird. The cycle turns uncomfortable. And rather than thinking something's wrong or thinking your portfolio is broken or the market's stacked against you or this whole thing is rigged, people would be better off thinking that market downswings are the cost of admission. It's like paying a tax. You can't get the annualized return of 8% a year without the occasional blip. And catastrophe, huge mistakes get made when people try to shun the uncomfortable part of the cycle. And again, this can show up in different ways. Like, we have clients that say, oh man, I'm down $50K this year. It's like, well, on $1 million portfolio, being down $50,000 is 5%. Okay. We just had the worst start to the year, the worst start for US large cap stocks since 1970. In a world where stocks are down 20% in 6 months, you are going to experience some level of pain. Everybody is going to experience some level of pain. So get over that, embrace it, understand it's the cost of admission. Do not shun negative outcomes. Don't try to avoid losses. That's where 99.9% of mistakes come from, trying to avoid losses. Embrace them.
I think what you said there is a really important takeaway about the way that someone quantifies where they are, maybe, let's say today. So when someone says I'm down 50,000, putting it into perspective, what does that really look like throughout your entire portfolio is a good switch of the mindset. Like 50,000 is a lot of money. That's hard. That's painful to look at. But when you compare it to how bad it really could be, then maybe it's not so bad.
So I'm a big fan of tracking sentiment, right? Are investors feeling euphoric? Are they feeling down? And what's interesting to me is, and this is why the behavioral side of investing is so intriguing. And I've said this many times, but when investors feel the best, like when they're euphoric, when investing's easy, when the markets are going up by 10% a year, future returns are the worst. Okay. So when people feel the best, future returns from that point on tend to be worse. The opposite is also true. When people feel horrible, like they do right now, future returns are best. And this goes back, again, 80 plus years of data over various market cycles. So this time, I like to use the mental shortcut of during an actual crisis, like now, I mean, I guess you can call this a crisis. It's been a pretty rough year for a lot of people. It feels like the worst thing ever. It feels like things are never going to get better. Fast forward a year and say that we're out of the woods, the market snaps back, inflation goes down. People will look back at 2022 and say, man, that was an obvious opportunity. Man, I should have shoveled money into the market. That's just the way human psychology works. Today's the scariest thing ever. You overweight what's happening today. You extrapolate it out into the future. You might even think things are going to get worse. But once you're out of that, once you're out of the forest and you can see the entire landscape, gosh, what an opportunity. I mean, rinse and repeat. You can set your watch to that.
So what about people who try to time the bottom, time the market, or even the top too?
I can tell you more money has been lost by people trying to time the top or the bottom, trying to market time because they think things are going to get worse, so they're predicting this catastrophic event. More money's lost preparing for the event, whatever it is. And you can't time a bottom. You can't time a top. No one can do it. The best investors in the world can't do it. So quit asking your advisor what they think about the next month or what they think the next 6 month holds. Know that every 4 or 5 years, things are going to get weird. The market's going to go down 10 to 20%. It happens every single cycle. Like, quit being surprised by surprises. Markets move in cycles. Negative outcomes are part of investing. Every 4 or 5 years, it's going to happen.
So give us the specifics on what exactly happens when someone is trying to time the bottom. What are they doing? Are they pulling everything out? What's the downside to that? What actually happens?
So the most common thing is people will sell for whatever reason and they'll wait some more and they'll wait for things to get worse. Things might get worse. Things might stay the same. Things might get better. But know that when you're sitting on cash, either you're waiting for a better entry point, you're waiting for the market to fall. Know that one, there's always going to be a laundry list of things that could go wrong. Like if I asked the average person on the street to create a list of things that could go wrong, it'd be very easy. That it would flow out of their mouth. If I asked that same person to give me a list of things that could go right, they'd probably stare at me, or they'd hum, they'd haw. It'd be much more difficult. Humans have a disposition to be pessimistic. It's much more interesting to be a pessimist. Okay, so people end up being paralyzed because of all these things that could happen. We've shared a chart in the past, like going back to 1970, and it outlines all the headlines going back to 1970 versus what the S&P 500 has done. The S&P 500 has basically gone straight up and to the right, despite all of these things that could have gone wrong. Okay, what ends up happening is this avalanche of news is bad today. People overweight that. There's a list of things that could go wrong, and the market, without any rhyme or reason, potentially snaps back. And it oftentimes happens like these inflection points. So when the market's down and then it snaps back up, they can happen for no reason at all. They can happen during the apex of the worst of it, the worst news flow. Think back to 2020, April or May of 2020, the economy was in shambles. We were all locked inside. The market just raced higher. Okay. The market doesn't have to jive with your view of the world. It doesn't have to do what you think it should do. Because A happens, the market doesn't have to do B. Markets don't work in a linear fashion. They're a complex system. Randomness happens. There's a million variables moving at the same time, and it's impossible to make these large active bets. And by large active bet, I mean selling 40% of your stocks and sitting in cash and waiting for a better entry point. That's how mistakes are made, and usually people end up holding the bag. So back to your question. The market usually races higher, and then you're left holding the bag. You're holding cash. You're not invested, and you're even further incentivized or further disposed to wait because the market leaked higher and it doesn't make sense. It has to pull back. Well, you just missed out on a 50% gain to the upside.
Yeah, one of my favorite charts or data points to look at is days missed in the last 10, 20, 30 years and how much that really affects your performance. So if you missed the 10 best days, you're behind by so much. And you never know when those days are going to be. They're super random.
Yeah. So quit trying to time the market. Quit listening to your Aunt Bertha. Quit reading financial news. Quit asking people what happens next. I mean, people like the illusion of certainty. Like there's a belief that someone out there knows what happens next. Look, the smartest investors in the world have no clue what happens next.
And have opposite viewpoints from the other smartest person next to them.
Yeah. No, yeah. So that's a great point. So when you are pounding the table for something to happen, know that someone 10 times smarter than you has the opposite viewpoint. Like a savvy investor wants to understand both sides, not just be a perma pessimist and only seek out information that confirms your own biases. Like that's not constructive.
Yeah, we talk a lot about confirmation bias and herd mentality. And filters. So let's talk about it again, because people need to hear things like 7 times over before it really clicks. So this might be number 8 or 9, but let's talk about filters.
Okay, so first, people, and I said this earlier, humans have a bias towards the pessimistic side, right? And the best example that I use is if I am telling you about my neighbor, right? And I tell you my neighbor just got married. And if I said, yeah, this couple is great, they're going to be married for 30 years or 60 years or whatever, 3 kids, a beautiful family, they never fight, they really enjoy each other's company, you would stare at me and be like, so, okay, right? But if I told you that the man has been sleeping with the neighbor who's 40 years older than him, and the wife has been cheating on the husband with her boss, and she was telling you all the juicy details, and you're talking about this, you would lean in, you would want to hear more, and you would be captivated by this story. And it's the same thing in financial news. If I tell you, hey, for the next 30 years, every 4 or 5 years, things are going to get weird, but the market's basically going to go up, things will be fine, things will get slowly better in this country. You would call me aloof, you would call me lazy, you would call me checked out, that I'm oblivious to the risks out there, right?
Mm-hmm.
But if I leaned into you and said, hey, I got a friend who works in the government, he's telling me inflation is 2 times what the reported number is. He thinks the market's going to crash by 50%. The dollar's going to collapse. They're going to ban cryptocurrency. Banks are going to fail. You would think I'm the smartest guy out there. I'm some savant with insider information. You would lean in and be captivated to what I'm telling you. People love narratives. They love a good story. They love a good train wreck. That's why when I turn on the cable news, you see 9 channels that are dedicated to like murder mysteries and horrible things happening. People love a train wreck. And if you understand that's how you're disposed, then you can do things to kind of mitigate and counter that. But most people are pessimistic. They don't understand that they're pessimistic, and they just seek out these doomsday scenarios, and then they act on them. And that's just destructive, ridiculous behavior.
Okay, first of all, I love a good murder mystery.
I mean, I can understand how that could be alluring, but it's basically a murder mystery anytime I go on OregonLive.com or watch the local news. Like I'm bombarded with enough murder and darkness in my life. I don't need to seek it out in my entertainment space. So it's just a little much for me is what I'm saying.
Yeah, it definitely can be. But so filters are important. You have to check what you are listening to. And back to our last point, it's good to seek out the different opinions, ones that challenge your own. It's all in kind of moderation. So
that's the pessimistic bent of most human beings. Watching mainstream financial news, reading every page of the Wall Street Journal, watching talking heads on CNBC, tracking the markets on your phone daily, that all feeds into that. And what those outlets are doing is selling fear. Like fear sells. And they're compensated. These media companies are compensated not based on your outcome, but on clicks and eyeballs on their content. So understand, again, the complex is feeding into your natural biases. If you don't acknowledge that, you are going to drive your financial plan and your portfolio just completely off the rails.
So the last thing that we have not yet touched on is obsessing over external factors that are out of your control. And again, this is another thing that we've talked about a lot, but it comes up almost daily.
Yeah, and I think that's a good point, Aaron. Like this isn't stuff that we just make up. This is stuff from us working with people day in and day out. I mean, I've been doing this for almost 20 years. You can set your watch to a lot of this stuff. Certain behaviors during good times, certain behaviors during bad times. So this isn't coming out of thin air. These are all real life case studies that we've seen over and over and over again, and we're just putting our own spin on it. So back to your point, obsessing over external factors that are outside of your control. So all the things that I just mentioned, watching CNBC, staring at your phone, watching every uptick and downtick in the stock market, those are all things that you cannot control, okay? And we often, it's maddening, and we see this every day, where someone is obsessing over things they can't control, but they're leaking oil in their own financial plan, in their own lifestyle, in their own choices, hijacking things they can control because they're so distracted by things they can't control. And what does that look like? It looks like taking on leverage, taking on debt in retirement, leasing expensive cars, having no clue what your expenses are, having 9 different brokerage accounts that aren't optimized for risk, aren't optimized for taxes, gifting money to your kids when you're basically on a thin line between a favorable outcome and an unfavorable outcome. Like, these are all things people are doing every single day, yet they're concerned about what the Fed does on Wednesday if they raise by 50 basis points or 75 basis points. It's absolutely ridiculous.
Yeah, there's a lot to unpack there. And we have at least 1 or 2 other episodes that really do a deep dive into things that are out of your control. But let's talk for a minute about people who have built their lifestyle around the last decade of markets really just only going up, and how that's manifested itself into people really panicking today.
Yeah, so this is back to my Buffett quote of seeing who's swimming naked when the tide goes out. And this is going to be a separate blog post. It's probably going to be a separate podcast because we've been noticing this a lot. And it's kind of alarming. And we've warned about the sequence of return risk before being the biggest risk to retirees.
Yeah.
And what sequence of return risk is, and this ties into my point, is the biggest risk to retirees and those that are about to retire is having a negative market outcome while they take out money out of their portfolio. And the earlier you are into retirement, the more of a risk this is. So if you just retire and you're 60 years old, if you take a picture on that date, your retirement monies have to last for the longest period of time during retirement. Okay, it's mission critical. It's the danger zone. So let's say the market pulls back by 30%. You're taking, let's say, 6% a year out of your portfolio. That is a potentially impaired capital base, meaning your investable assets are taking a potentially permanent loss because you're taking money out and you've lost 30%, and you won't be able to recover. You won't be able to support your retirement lifestyle because you've taken such a big hit. Okay, so that sequence of return risk. What I've noticed happening now is kind of a play on that, where let's say someone has been retired for 7 to 10 years. Okay, they're used to taking a certain amount out of their investment portfolio. Kind of the mental shortcut is you can take 4% a year out of your portfolio and be fine. What I've noticed is most people take more than that. I mean, if I was to make a
ballpark
guess, a ballpark guess, I would say people take more than 4% out of their portfolio each year, which in a up market, like the last 10 years where the S&P's going straight up, essentially, you can get away with that. So let's just use a nice big fat example.
We'll get away with it and not really notice.
Right.
Because what you've taken out, you don't see any change year to year on your portfolio value, really.
Right. So let's say you have $1 million invested and you take out $80,000 a year, which would be a distribution rate of 8%. That's double of what so-called experts say that you can take. Okay. If the market's up 10% a year, you're $1 million at the end of year one, 100,000 gain. So 1.1 million, you take out 80, you have a little over $1 million. Hey, great. This is perfect. We traveled, we spent all this money. I got a new car. I can spend 100,000 years out of my portfolio and actually gain ground. So this happened for basically a decade straight, from middle of 2009. We had a couple blips, but basically up until the end of 2021. All right. So people built their lifestyle. They built their expenses. They built everything that they're doing day in and day out around the premise that markets go up by 10% a year. Okay. Well, what happens when we get a ugly year like 2022, where people are down anywhere from 10 to 40%, and they're still spending like the market's going up by 10% a year? You get someone who all of a sudden is at risk of running out of money if we get another difficult year or a series of lower future returns. And I can tell you, it's really hard to tell someone to downshift. Once you're used to spending Social Security, your pension plus 100,000 a year out of your portfolio, it's really hard to downshift. It's really hard to cut back, which is why these personal finance people say lifestyle creep is real. Lifestyle creep is as you make more money, you spend more money. They warn against that because it's almost impossible for most people to downshift and trim stuff off their budget once you get used to a certain lifestyle.
Yeah, the things that used to be a luxury become an essential, and it's almost impossible to reverse that.
Yeah, and for us, like we can't tell you how much to go out and eat. We can't tell you how much to travel. We can't tell you what to drive. So the onus, it's a lifestyle choice, right? The onus is really on the investor, the person that's retired, to look in the mirror, to have an accurate handle on their budget, which sounds like basic planning. Aaron, I think you threw out a figure of 70 to 80% of people have no clue what they're spending.
Yeah. I mean, that's my own probably ballpark too, but
I'd say it's pretty good.
I think that's close to accurate as much as you can be.
So,
but it's tough. Yeah.
Not to rail, like I sound like I'm railing on people today. It's just we're seeing these destructive behaviors. We're seeing we're not seeing the changes and the things people should be thinking about during a difficult market environment. And our whole premise of this podcast is to get people to think more objectively, to look in the mirror, to recognize your biases and blind spots, because we all have them. I have them. Aaron has them. Everybody has them. Mm-hmm. And the things that we hear during good times are often ignored, and they all of a sudden become enlightening during bad times. The idea is to always have your listening ears on, to always have a pulse on your financial plan, even during good times, especially during bad times, but not to make these reactive decisions and have to change the course of the ship just because things are bad.
So quick summary here, things that you should avoid during a bear market, difficult market times. So we know that boring advice becomes super enlightening during hard times. So the things that you were once told when things were normal, continue with that when things are more difficult. Don't obsess over the external factors that are out of your control. Look inwards, see what you can control today. Stop trying to time the market. That's pretty simple, easy advice. You are not smarter than the markets. Seeking risk when things are good and shunning risk when things are bad is not going to get you anywhere, because negative outcomes are just part of the cost of investing. Get your filters intact. Seek other opinions that do not just confirm your own, but also challenge your own. And we know that investors have a bias to pessimism. So if you are leaning on the pessimistic side, also look for some more optimistic news, because good things are happening too when it seems like everything's going up in flames. Okay. Thanks for listening to this episode of Blind Spots. If you have any questions, you can always reach out to us at insight@pureportfolios.com, or find more about Pure Portfolios at pureportfolios.com. So we'll see you in our next episode.